Opening slide. Well, how would we characterize the mood of the markets at the moment? I think we'd use two adjectives here. We'd say they were cautious. That caution comes ahead of the FOMC meeting, the Federal Reserve meeting, which will decide on interest rate policy for the US for the coming month. It's likely that this meeting will see the end of quantitative easing in the US and the start of the new post-easy money environment. So markets are cautious. They don't know how to treat that. They don't know exactly what the Fed's going to say. They're hoping they're not going to say it's the end of QE. We think it probably is. Unforgiving. Unforgiving, yes, where it sees no change. And that was demonstrated very clearly yesterday when we saw the Brazilian real fall by more than 3% against the US dollar following the re-election of the Brazilian President Dilma Rousseff. She's not the most popular person, and her previous, as far as the markets are concerned anyway, and her previous term was one of economic stagnation and civil unrest. I think we'll all remember the rioting before the start of the last World Cup. The Brazilian lower middle classes feel particularly hard done by under her, and the market doesn't believe there'll be much in the way of change, hence the sell-off in the Brazilian real. And you can see how that currency has weakened sharply if we look at the chart on the right hand side, particularly from well, July 2011. It's just a straight 45-degree line, and yesterday's sell-off, I think, were new 3-year lows. So moving on from there, sound bites. Here we just try and take a few snippets even from the media and just to give a flavour. And here we're looking really at what people are saying and thinking about Japan, and I think the truth is really nobody really knows what is going to happen in Japan. So Japanese consumption taxes, if you're not aware, Shinzo Abe, the current Japanese Prime Minister, introduced a higher rate of consumption or sales tax, if you will, back in April. There's a potential for that to rise again in November, and people are just questioning really what that means. So from the economists, first of all, the last time politicians dared raise a consumption tax was back in 1997, and it helped push the recovering Japanese economy back into recession. Then, however, the move coincided with a financial crisis and stroke storm in Asia and a bad loans crisis at home. This time politicians even seemed sure that people would soon go back to the shops, yet the fall in household demand has proved even sharper than in 1997, and a recession is again on the cards. And remember that Japan really hasn't for all intents and purposes been anywhere near growth for the last 20 years. Japanese retail sales, this is the next quote, Japanese retail sales rose the most in 4 months this morning as a sign of the economy is shaking off a blow from a sales tax increase in April as Prime Minister Shinzo Abe weighs another bump in the levy. Yeah, it's true to say Japanese retail sales were up. They jumped sharply month on month, but I think many people there are thinking that people, if you were going to make a large ticket purchase, you went and did it now ahead of a possible rise in the sales tax next month. And then this from Reuters, just a few days ago, Japan's economy is floundering, and analysts polled by Reuters cut their annual growth forecast for a 5th straight month, saying that there is no chance that the Bank of Japan will meet its 2% inflation goal by the end of the fiscal year. It's a real experiment as far as monetary policy is concerned in Japan, and as I say, nobody's really sure what's going to happen there, and that's why it's very interesting to watch dollar yen so closely. Okay, now the next slide, what the money thinks. And I've taken this slide here today from a series of slides from a very interesting article on the blog businessinsider.com. This was from a piece they did called the 12 most important charts right now. This is from a very respected commentator, a guy called Cullen Roche, who's the founder of Orcam Financial Group, and he pointed out points out from his perspective the Eurozone needs restructuring. What this chart shows us is the industrial production in the USA versus the Euro area since December 2009, and what we can see is clear divergence that kicks off around August 2011. Probably, if we think back, that was around the height of the crisis with the so-called pig economies, the likes of Greece, Portugal, Ireland and Spain. And you can see that US industrial production has just risen consistently, up around 20% over the time frame, whereas the EU has struggled to maintain even a 5% growth. Mr. Roche thinks that a restructured EU could actually be a very, very beneficial thing, not just for the citizens of Europe, but for trading partners around the world. If a healthy, functioning Europe, he thinks will be a very powerful trading bloc. I think he's probably right. Unfortunately, the structural issues in the EU are such that it's going to take a long time for us to get there. Okay, right. Well, let's move on to the proper business of the day then, having considered those. The long and the short of it, interest rates, decisions, what they are and why they matter. Okay. So first place to start probably is for the definition of interest rates. And interest rates are the cost of money charged to a borrower and the return demanded by investors for lending or investing money. And in modern economies, interest rates and interest rate policies are determined by the central bank. And this is often done independently of government, so free of direct political interference. But the government of the state in question or the region in question may well set targets for the central bank to achieve. And for instance, here in the UK, the Bank of England has been set a target by the Treasury, by George Osborne, the Chancellor, to try and achieve an annual rate of inflation within the UK of 2%. And this will be as measured by one of the two main measurements for inflation, in this case the Consumer Price Index rather than the Retail Price Index. And the Bank of England tries to set an interest rate policy that it believes will achieve that. Now, it doesn't try to do it necessarily to achieve 2% inflation tomorrow, but it tries to set an interest rate policy that it believes will achieve the inflation target in the fullness of time. So it's looking forward into the future, perhaps as much as 18 months to 2 years into the future, and where it believes it can achieve that. Now, the truth is that inflation here in the UK and in many other countries, as we'll see going forward, it has undershot dramatically. And we're some way from achieving that target. Just as a point of interest, if the Bank of England fails to hit that target by certain parameters, then the Governor of the Bank of England has to write to the Chancellor, George Osborne, and explain why that was and what he's going to do about it to try and correct matters. Okay, so let's move on to our next slide. Interest rates are calculated over, or rather they vary over time, and interest rates are calculated over a variety of time frames, and this extends from what's called overnight money, the very shortest period one can lend money on, right out to 30-year mortgages and bonds, which is probably amongst the longest timescales that money is lent on, and that's typically done against, say, mortgages or infrastructure products, or perhaps government bonds, which we'll come on to in a moment. The differential between these rates and timeframes is known as the yield curve. That's something that you will hear people talk about from time to time, particularly economists and market strategists. What the yield curve does is it plots expectations for the cost of money into the future, effectively pricing where the market will lend money for a given time frame to a credit-worthy borrower. It's always worth bearing that in mind, that when people talk about interest rates, base rates and yield curves, they're talking predominantly about the rates that would apply to what we would once have thought of as a AAA borrower, but certainly a borrower that is credit-worthy and is likely to be able to pay money back. So what does a yield curve look like? Well, they vary in shape, and they vary obviously in terms of shape, in terms of the tenure and the currency as a time frame that we're looking at. But here's the yield curve for the UK. This is a yield curve out to 25 years hence. This was drawn on data extracted from the Bank of England statistics page on the 22nd of October. And if we look here in the bottom left-hand corner, you can see at the very shortest timescales, money was available or around 0.43%, so actually slightly below base, which suggests there was a surplus of money around on that day. And if we look how the curve moves quite sharply upwards, so in 2 years' time, the expectation is that rates could be, 5 years' time, rates could be somewhere around 2.5%. Out to 10 years, and we're looking at something around 3.32%. A peak here at 15 years for UK interest rates, according to this yield curve anyway, and the expectation here of the market was they'd be around 3.67% out to 15 years. And then here, out at the 20-year point, we've dipped off again, market expecting something slightly lower, around 3.64%, at least that's where it's implied through the rates it would lend money at. And then right out to 25 years, they've tipped off again, and 25-year money, the rates there around 3.35%. So that's the UK curve. Obviously, we're still in a low interest rate environment here in the UK, but the expectation is that rates will rise sooner rather than later, certainly on that curve. But here's a completely different looking curve. This is a Japanese 10-year yield curve. Now you might think that this is, it's just a sharper rise in interest rates, but what we need to do, perhaps we saw in the UK, but what we need to do is consider the scale. Now where we were talking about whole percentage points on the left-hand scale in our UK yield curve, here we're talking about fractions of a percentage point. So we start off here, 1 month money error, literally 0.02% is where that's valued at the moment in Japan, where one can borrow 1 month's money. Right out here to the far right-hand side of the chart, 10-year money, 0.15%. So basically, Japanese interest rates are flat. They're staying flat for anything up to the medium term. There's a very, very strange situation in Japan. In some cases, rates have even turned negative, and that means that investors have basically had to pay banks to look after their money. Now let's move on and compare those two charts. So you can just see, the massive differential in the way the market views the likely path of interest rates between the UK and Japan. So this is the UK 10-year interest rate curve plotted against the Japanese data that we just saw. Okay, that sharp pickup in UK rates, heading ultimately to around 3.5% in 10 years' time. Japanese rates, though, they are higher, but they are effectively static as well. If one can say that, they move from next to nothing to next to nothing and a little bit more, and that that red arrow exemplifies the massive differential between those two. Now, why is that of interest to us? We'll come on to that as we move through the next few slides. Right, bond prices and yields. Well, governments borrow money via the financial markets to finance their obligations and spending plans. If they can't raise enough revenue through tax, then they need to go and find the money elsewhere, and they find that money through the financial markets. They do this through a process that involves the issuance of bonds, and these bonds are effectively IOUs through which the government guarantees to pay back its loans by a fixed end date. Bonds will pay a coupon to people who buy the bonds, to the lenders. That coupon is effectively the rate of interest that the lender can expect to receive over the term of the loan. UK government bonds are known as gilts, so when people talk about gilts or gilt-edged securities, they're talking about the bonds issued by Her Majesty's government here in the UK. But other familiar bonds, T-bonds, the US Treasuries, Bunds, the German paper, and you may hear people talk about BTP and OAT, which are the Italian and French equivalents as well. Now, bonds are quoted in pounds, dollars, euros, or yen %. So they are, and what that basically means is they're priced out of 100. They are priced basis the credit quality of the borrower. So the better the credit quality of the borrower, the better the likelihood of the borrower to pay the money back, the smaller the charge the markets will place on them borrowing that money. Bonds are priced also based on the coupon that they pay, the rate of interest that they're offering to the lender, the time left to maturity, so how long before I get my money back, and the expectations of interest rates over the lifetime or the term of the bond. Now, yields, which you hear people talk about, the yield is basically the rate of interest an investor would receive by owning the bond. Yields are inversely proportional to the price of bonds. What that actually means is that as bond prices rise, yields fall, and conversely, as yields rise, bond prices fall. So in other words, as bond prices rise, investors receive a smaller return or reward for holding those bonds, whilst as bond prices fall, investors will receive a bigger return, brackets reward, for holding those bonds. And these bond prices reflect underlying interest rates, such that if interest rates rise, then bond prices will fall, i.e. bond yields will rise, to reflect that, such that bonds remain attractive against bank or money market deposits. So just think about that. Interest rates rise. Let's say you've got a bond that pays a 3% coupon, interest rates rise to 6%, 3% versus 6% doesn't look very attractive. However, the yield on that bond, the price will fall on that bond, and the yield will therefore rise on that bond to bring it back in line with interest rates, to make it look more attractive against those bank or money market deposits. So as I say, the phrase to bear in mind is that yields and prices in bonds are inversely proportional. So what about interest rates and currencies? Well, just as bond yields reflect the return investors receive for holding bonds, so rates of deposit or interest rates reflect the rewards that investors receive for owning a particular currency. These rates will vary over time, and the cost of ownership of a currency over different timescales also changes to reflect that. Modern FX markets calculate rates for trades that specify settlement at some future point, and this could be 1 month, 3 months, or 12 months ahead, or any point in between, and they calculate these rates on a daily basis, 24 hours a day in fact, alongside the spot rates that we are all familiar with. The forward rates that for currencies reflect the interest rate differentials and inflation expectations along the curve for the currencies in question. So if we think back to our yield curve there, which we were talking about bonds, a similar thing, very similar thing applies to currencies. Markets are pricing their forward expectations of what a currency might be worth in a year's time, for instance, basis their expectation of rate changes, the effect of inflation, and sundry other factors. And let's just have a look at an example of that. And here's a table just drawn from the Financial Times, shows quite straightforwardly the spot rates for sterling based on the 22nd of October against a wide variety of currencies, and it also shows us what the markets, or how the markets are pricing the forward rates, which we've highlighted here with the red ovals, 1 month, 3 months and 1 year. And down at the bottom here I've flagged cable, sterling US dollar, and spot rate here, and here we see the rate for 1 month forward, a 3 month forward, and all the way out to a year hence. So those rates are being calculated all the time. As I say, the key thing to bear in mind here is that forward rates are based on interest rate and inflation expectations for the two currencies concerned. Okay. So now we need to look at the potential elephant in the room as far as interest rates and real returns are concerned, and that's inflation, although not today but going forward we'll also look at its even more unpopular cousin, which is deflation, and you'll hear more about that, I'm sure, in the press over the coming weeks. But let's focus on inflation for the moment. Now, inflation, sometimes known as money growth, occurs, and this is a very simplistic definition, but it's the one that I think sums it up quite nicely. It occurs when too much money is chasing too few goods and services within an economy. Now, some level of excess demand, which is really what inflation is in fact healthy for an economy, as it can promote expansion within that economy. And as we saw earlier, UK government has given the Bank of England a 2% inflation target to achieve as an example. However, with a capital H here, excess demand and inflation can be very damaging for an economy if the domestic market cannot meet the excess demand for goods and services. And what we're talking about here is something, an imbalance of, or the potential for an imbalance of trade and a balance and payments issue, which we touched on in one of our previous webinars. Now, in this circumstance, if there is excess demand or inflation within an economy and the local businesses are not able to meet that, goods and services must be imported from abroad. This means, of course, selling our local currency to pay for those goods and services, weakening the local exchange rate, and thereby effectively driving up the price of those self-same imports of goods and services in local currency terms over time. If we keep selling local currency to buy goods and services from abroad, the currency will weaken. The effective cost of those goods and services rises over time. But unfortunately, with the prices rising, that's another inflationary lever, and so we have the potential for a vicious circle. A weaker currency, of course, should be good for the country's exporters. However, in this example, as we've already seen, there was no spare capacity to meet domestic demand, so there'll be little spare capacity in the economy for exports. Okay, well, the central bank doesn't sit idly by. It decides it needs to act, and it needs to cool the excess demand stroke inflation in the economy and defend the currency by progressively raising interest rates to try and tighten the supply of money. It makes money more expensive. It tries to take it out of the economy and persuade people to save rather than spend, and just make it, you know, harder to come by. All well and good, except that perhaps unintentionally higher interest rates attracts international capital into the local currency, which now provides a higher rate of return than its peers. So remember, we said that the interest rates, deposit rates, were the reward that investors in a currency would expect to receive, and here in our example, money's coming in, people are getting a better rate of return than they can on the currencies of neighbouring countries, so money flows in. Now that might be good news in the near term, except for the fact that that could potentially fuel an inflation in the price of local assets such as property. We don't need to look too far for an example of inflation of property prices when money floods into a country. We've seen that in London, particularly in high-end London property. Prices have gone through the roof, and that's had a ripple effect throughout the rest of the UK economy. Now this money comes into our fictitious example here, into this local currency, until inflation rates meet or exceed the rate of interest that investors have been receiving on the local currency. And at this point, investors start to experience flat or negative real returns. Now real returns can be defined as the return or the rate of interest received by an investor minus the rate of inflation. And we touched on this when we looked at that stacked bar graph last Thursday, when we looked at varying types of economies, with those with low and moderate growth and you know, differing rates of inflation. But the worst possible case scenario, or one of them, is an economy where inflation outstrips interest rates, and therefore the real value of money is being eroded on a daily basis. It's not all bad, of course, because if you happen to be a borrower, then in that scenario, the value of your loans being devalued very quickly, and you know, you'll have to pay less money back. But for everybody else, it's potentially a nightmare. And in the worst case scenario, inflation runs ahead of interest rates, and at this point, the local currency has a credibility issue and will likely be sharply devalued or sold on the global markets. Of course, a weaker currency just makes foreign imports dearer, driving up prices and inflation further. And obviously a classic example in recent times of that was what happened in Zimbabwe, when inflation just got completely out of control and, you know, went to effectively was hyperinflation, and the Zimbabwean currency collapsed into, you know, worthless paper. Now, of course, as I just said, you know, these are quite simplistic examples, but it certainly shows what can happen and what can lead to a balance of payments issue. So, our final slides for today: interest rate policy. In modern economies, as we said, the interest rate policy is set basically by the central bank with varying degrees of political oversight. In the USA, the Fed's Federal Open Markets Committee, or FOMC, sets US interest rate and monetary policy. They meet monthly, and quite by chance they're starting one of the most important meetings. It's October meeting today. The meeting will last 2 days, and we'll have an announcement about policy, about what they're doing about QE, I believe, on Wednesday. We think that they're likely to confirm that they're the winding down of their QE program, and that will likely end at the end of this month. And in doing this, they're actually ahead of other central banks. So America's taken the lead. We saw that chart of industrial production earlier. The US economy looks very healthy, and the Fed probably put, the view of the Fed is that they can afford to take their foot off the gas to a greater or lesser extent. They're probably not going to raise rates just yet. I think that low rates are here for some time, but they want to get the market ready for that. We'll know more, as I say, in the next 48 hours. In the UK, it's the Bank of England Monetary Policy Committee who set the interest rate policy and the monetary policy. Again, they meet monthly. They're meeting again on the 5th and 6th of November, and I'm a dreadful pun there, I put no fireworks expected, but the truth is that rates in the UK and quantitative easing are unlikely to change, so rates no change. We've done 375 billion of quantitative easing. They're not likely to deviate from that. That's paused and likely to stay that way. In Japan, the Bank of Japan sets Japanese monetary policy. There's more political involvement in Japan, whether it's implicit or tacit, but very much as is the case with all of the economy in Japan, the government has a hand in everything. Between them, the BOJ and Japanese government are trying to reflate the beleaguered economy. The weak yen policy, which is designed to help exporters and try and drive a bit of demand through the economy, that does seem to be working, but inflation and growth for Japan have proved elusive. As we saw earlier, Japan is flatlining in many regards. Interest rates, as I said earlier, have often been negative, with customers having to pay banks to hold their cash. And there are calls for further stints of QE, but even if they are applied, I think it's unlikely to change the 20-year trend, and maybe some other drastic actions required there. They've got to think outside the box once again. They're meeting again, I believe, on the 6th of November as well. The European Central Bank, or ECB, is probably the most politically influenced Western central banks, and has the hardest task managing interest rates and monetary policy for the disparate economies of the Eurozone, such as Greece and Germany. You couldn't imagine two economies with more structural differences than Greece and Germany, yet we have one central bank, one currency, and one interest rate policy. At the moment, the ECB is concerned with trying to stave off deflation. The last sort of 4 or 5 years of stimulus measures haven't really provided any sustainable growth within the EU. As I say, the consequences of that could be flatlining growth and the potential for deflation, which we'll cover in a coming seminar. It has started a modest asset purchase program. It's buying asset-backed and covered bonds in member states, but it hasn't started a full-blown QE sovereign or quantitative easing sovereign buyback plan. There's a meeting of the ECB on the 6th of November. It's unclear exactly what the next step will be. The biggest fear, of course, for most of us is that the ECB slips in, or the Eurozone slips into a Japan-like flatline zombified economy, and the ECB will be desperate to try and stop that. Whether it can or not is a moot point, but let's see what Mr. Trichet's got to say. Not even Mr. Trichet, Mr. Draghi's got to say at the press conference on November the 6th. So I've taken up plenty of your time now. I hope that's given you some food for thought. It's probably appropriate for me now to hand over to Clive, and he's going to give us a talk through the basics of, or an introduction to candlestick charting, I believe.
I think that is the plan, Darren. Yeah, thank you very much for that again. Once again, lots to think about there, and a very thorough sort of run through from Super Daz. I think you're talking about what the central banks have to do, and also you were talking about the sort of hyperinflation thing. Let me just do this thing again when I get the right screen. Probably that one there. And I think that's an interesting situation there, obviously, with the ECB, Darren, in that they haven't done, as you said on your slides, full-blown QE yet. And I think that there's a big, and you did also obviously point out the fact that there's political disparities throughout the Eurozone. Obviously, one of the big ones is Germany. The Germans having one of the stronger economies in the EU, and worrying about going through another hyperinflation type scenario, because you mentioned Zimbabwe, but Germany had one all of their own back in the 30s, and there's a very interesting book about it that actually I think Warren Buffett suggested to everyone they should read, and it was called When Money Dies by Adam Ferguson. So have you read that, Darren?
I've got one on the go at the moment called The Failure of Money, which is exactly about that same topic. So it's a great read, and I would suggest anybody who's interested in economics and financial markets look at that, because it's always good to see things in extremis.
Well, exactly, and I mean there's a strong argument that the hyperinflation, what was known as the Weimar hyperinflation of that era is a direct sort of directly caused, if you like, the Second World War and the rise of the Nazis. So it's an extremely it's obviously a very interesting. I've got my kids to read this book, which is a bit sad. No, they're doing history at school, so it's not completely irrelevant to get them to read it. That's the book I'm talking about. Just grabbed it up on Amazon for you. When Money Dies: The Nightmare of the Weimar Hyperinflation. And I'll tell you what, that really is a good book. I would highly recommend that. Talking of good books, there's a book here called Japanese Candlestick Charting Techniques. It's written by a chap called Steve Nissen back in the 80s. And Steve Nissen was one of the first people in the Western world to introduce candlestick charts to us, if you like. And yeah, the guys in Japan had managed very well to keep it quiet from us in the West up until that point. But yeah, so Steve Nissen's book there, Japanese Candlestick Charting Techniques, it's kind of like my Bible, except then somebody came along and asked me actually to write a book on candlestick charts. So I did. There's my attempt. It was published a few years back, and so that's Candlestick Charts by Clive Lambert. And that is much cheaper than Steve Nissen's book, and also is in colour, so you can decide which one you would find more stimulating, if you like. So as I said, candlestick charts really didn't become popular in our part of the world until until recent times. The psychology behind these charts has been used by Japanese traders as far back as the 1700s. There was a rice trader in Japan called Muneshi Homa, who was such a good trader and so well respected in the rice markets in Japan and in Dojima back in the 1700s that he was elevated to samurai status, which is always a great story, I think, to tell. So if, we're all striving to be good traders and make a few quid, but I'm not sure any of us will ever reach samurai status. Anyway, let's have a look. Let's get cracking and talking about candlestick charts. I've got a few slides that basically are going to try and talk you through the very basics of it and the construction, and I'm going to show you one pattern today, and then I'm going to show it to you on a chart, and hopefully it's something you can look out for that might set you on your journey towards using candlestick charts as part of your daily routine, if you like. I think the idea when we started doing these webinars was very much that Darren can do what he does well and has done well in sort of giving you that broad brush idea of how the big picture works, and so you can come up with ideas of what you think. I think that the European economy is weak and but the UK economy is stronger, therefore I'd be looking to sell the euro and buy sterling. If you had that view, then you'd want to then go to the chart and say, okay, now I need to see if there's anything on the chart that agrees with that idea, or if not, where are the levels, or what are the signals I'm going to wait for and look for in order to allow me to put that trade on and try and have a trade that can work with that idea, but do so make sure I get in at the right time and at the right levels, and that's what trading's all about. And I tell you what, it's not easy. I saw something today about hedge fund managers having a very tough October. These guys are the best traders in the world. You do need to educate yourself and find the things that can work for you, and that's hopefully what we're doing here, is giving you some pointers as to what you might be best served to look at from a fundamental and a technical point of view. Anyway, I went off on a bit of a tangent there. I'll try and get back to my slides and get through what I want to talk to you about candlesticks. Candlesticks basically present the basic data set the same way as bar charts. They use the open, high, low, close. That's what a bar chart looks like, and that's the traditional sort of Western, if you like, method of charting a particular market. And has a bar for each day in this particular instance, and each bar shows you the open, high, low, close for that day. And that's what the candlestick chart looks like. You can see it pretty much looks the same. There's not really a huge amount of difference except for a colour scheme. And the colour scheme, in this case green and red, shows you whether that particular day was an up day or a down day. And really, I think I've said this to you before when we were doing the support and resistance run through, that what you really want to, probably the easiest way to try and trade markets is to identify whether the market's going up or down, and try and be on that side of the trade, and also look for potential turning points where that balance might be changing. That shift between bulls and bears might be that balance between bulls and bears might be shifting. So candlestick charts, I'll actually skip to the next slide, which is that one. That colour scheme there is everything is what I'm going to be showing on my slides today. And what we have is a candlestick is basically green or red, dependent on whether the market has opened low and closed high, in which case the difference between the open and close would be represented by that block of green. And this one over here is a bearish candlestick. The sellers dominated on this day. We opened here and we closed down here. Okay, now this line through the middle here is the range of the day. So the bottom, the bottom of that, what's known as the lower shadow, is the low of the day. Up here is the high of the day. So on this particular day here, if we think about it, the market started here, went down to here, up to here, and then closed there. And because it closed above where it opened, the candlestick colour would be green. And that's that bit in the middle, actually, the difference between the open and close, is known as the real body of the candlestick. And so over this side, we have a bearish or a red black filled candlestick, because we opened here, we got up to here, and then sold off down to here and closed here. We closed below where we opened, which represented on the chart as a red candlestick, or a candlestick with a red real body. So that's candlestick. That's the basic construction, if you like. There is one more thing to talk about, and I've just covered this really. The bit in the middle, the difference between the open and the close, what I always call the fat bit in the middle, is the real body of the candlestick. As I say, the difference between the open and the close. The bit above the top of the real body to the high of the day. Some people call that the upper wick, because we are talking about candlesticks, and I suppose that would look like the wick on a candlestick, but it's actually known as the upper shadow. Let's get the terminology right. I don't want to upset our Japanese friends. There, down here, the difference between the bottom of the real body and the low of the day is known as the lower shadow. And it's important to get a grasp on these terminologies, because with different candlestick, different shapes of candlestick, and different the relationship of the real body, the size of the real body, the size of the upper shadow, lower shadow, all of those things can give you clues as to what's happening in the market and who's bossing, whether the buyers or sellers are in charge. Maybe if that balance is on the move, and whether things are changing. So that's exactly what candlesticks are trying to do for us. And let's just look at 3 different candlesticks that are all really quite different, in order to try and give you a simple grasp of what this is all about. Because basically, as I've already said, candlesticks are trying to give us, and I think they're the best thing, the best tool for this. Any chart is actually there to try and give you a graphical representation of the state of mind of the market, the bulls or the bears. As a technical analyst, I think I mentioned this in the previous webinar, we talk about the market as a battle, if you like, as a fight between the buyers and the sellers. And what we're trying to do is work out who's winning that fight, and I want to be on the winning side. There really is no, pride should not be involved, loyalty should not be involved. History is obviously, the chart tells you the history, and generally you'd want to be backing the group that have been historic, have been dominating in recent history. But yeah, and that's what we're trying to do with the chart. I think I'm rambling now. Sorry. Right. Here we go. This one here, right here on the left-hand side, there's a candlestick that has, well, basically it's all shadows, isn't it? There's no real body to it at all. Okay, we opened, and what that means is we opened and closed at exactly the same price. Okay, now, what does that mean if we're thinking about our balance between buyers and sellers on that particular day, if you like? We'll still talk about days for the minute while we're talking about the theory, if you like. On that particular day, that's better. Yeah, that's I need that up there. That's much better. On that particular day, right there, we opened and closed at the same price. Okay, we did go up to here at one point. We did sell off right down to here another time during that day, but actually the net result of the of the buying and selling, the price action and the pushing and shoving that went on that day was that we ended up right back where we started. And quite often what's known as a doji, the small or no real body, these doji day can be seen at extremes of price. They can, if a market's been pushing higher and higher and higher and higher, and suddenly you get one of these appearing on your chart, you can say, well, the bulls aren't in charge anymore. They weren't on that day. Let's see now, going forward, whether that translates into a tipping of the scales in favour of the bears, if you like. Whereas what we've got over here is what's known as a Marubozu candlestick, and this is a Japanese word for shaven head. And I'm just going to grab a quick glass of water. The vote's drying up a bit. There we go. Right. Okay. Marubozu candlestick is basically a candlestick it's quite opposite to the doji, isn't it? There is no shadows on that thing at all. It's all real body. Now, what that candlestick means is we opened here and we closed down here. Okay, we just sold off, you arguably just sold off all day, from open to close. The first thing that happened on that day was selling. The last thing that happened on that day was selling. The bears, the sellers, dominated that session. And so a large red or black candlestick says to you that bears, the sellers, dominated. And this is just the opposite. Here we've got a bullish Marubozu, as it's known, where the buyers dominated throughout the session. The first trade was the low of the day, the last trade was the high of the day, and the market just pushed higher throughout the day. I do slightly bend that definition slightly from Marubozu candlesticks, but we'll come on to that later on, or maybe in later sessions. But I think, this particular slide is trying to give you that sort of, get you thinking about even just the shape of a candlestick can give you clues as to, and get you thinking. It needs to get you thinking about who's in charge, the bulls or the bears. Okay, now what's this next one? That's good, my friends. Candles for small real bodies are the results of a session where the market opened and closed at similar prices. Large body candlesticks are formed when the market closes a long way away from the opening price. And the real body of the candlestick represents the difference between the open and the close. Here we have a chart for silver, and this is an old chart. I quite like using some of my sort of old traditional charts to say, to illustrate a point, because there's always a bit of history behind these. This is when silver hit $50 back in, I think it was 2011, and you know, you can see throughout the life of this chart, we've got, you know, this chart shows mid-February, silver at $30, and just a steady rise. There's a couple of doji candles there, and a bit of a fall off, but then we started again. We're making higher highs and higher lows, but then suddenly this thing starts to sort of go parabolic, if you like. It starts to sort of try and shoot off the top of the chart. But there we go. On those particular days there, we suddenly have these massive swing days. These, you know, we have that. I don't know what's going on with these things today. Look, I'm going to take that off because it's not really working. But there we have a doji. We have market going all the way up to 50 and all the way down to 45. That's a huge, you know, daily huge volatility for one day. Okay, we're talking about 10% volatility in one day. And a few days later, we get a similar kind of thing, all right, tighter ranges, but again, the market's trying to go back up to $50. It's no coincidence that that's a round number, I don't think. We've talked already about support and resistance levels, and the fact that resistance levels can sometimes happen at psychological levels. Silver could not get through $50. And these doji candles showed that there was a massive fight going on between buyers and sellers when we tried to get through $50, but we just couldn't do it. And so there's only one way to go from there. And I remember going, you know, this is one of my, I was going on CNBC a fair bit around this time, and I remember this is one of my, you know, better calls. I said we will never see $50 again in silver. The market is, that is the top. And it was. We're now down at 17, 18. What is silver today? It's you know, it's now down at $17 and hasn't been near this $50 mark since. It really was a very clear, very obvious top, if you like. So the doji candles were the thing that really sort of swung it for me. We can see doji candles appearing in a downtrend to say that the market's going to turn around as well. So they can actually do the opposite job. They can say the market might start, you know, they can say in a falling market like this one here, and this one is cable selling off to a previous support level, but suddenly we get these doji candlesticks, and that must make you think, whoa, hang on a minute, we've got down to an old support level. We're posting these indecisive, these candlesticks that say we've got this even balance. I need to entertain the idea that the market may now turn around. And once you start to get the green candles, you know, that with every green crandle? What's a crandle? With every green candlestick, you get more and more confirmation that the market has indeed bottomed out and is now travelling in a different direction. So where am I for time? I'm good for time. I've got about another 5 minutes. I'm going to talk to you about one particular candlestick pattern called the hammer. Every candlestick pattern, as we've already seen with the doji and the Marubozu candles, has a set of rules. The hammer is one of the most potent reversal patterns. The hammer is a bullish pattern when seen during a falling market. So there's our 4 set of rules. It's got a small real body, okay, so the difference between the open and the close is fairly small. The real body is at the top end of the day's range, okay, so it's up here. There's not much upper shadow, or there's no upper shadow, either or, but that leaves us with a long lower shadow. Okay, so there they are, and then, rule number 4, very important, is that these are seen during a downtrend. And if you see this shape of candlestick in a falling market, you know, the idea is, and the suggestion is that the buyers have returned, and you look to see what happens from then on to give you an indication of whether you should be backing the buyers now, because they are now in charge. And there's a couple of examples of hammer candlesticks, small real body, long lower shadow in a falling market, and that reverses the market. That was a particularly topical one. That was when, it's not very topical anymore, but it's again one of those charts that's got a bit of a history lesson behind it. That was the very first smash lower when it was announced that Bear Stearns were doing a write down of their subprime mortgage book. I was stuck in Australia at the time that happened and was feeling a bit cut off from it all, actually, if I remember. There's the S&P getting down to a level of 1,000 a while back as well, from which it bounced, and the rest is history. But each time we got near to there, we were posting these little, we were posting hammer candlesticks to say that buyers are reappearing. And again, that was at 1,000. That was at the S&P at 1,000. So the psychological impact of the round number came into play there as well. So why is a candlestick shaped like that a potential reversal? It's because this is what has to happen on a day, on a day over the course of the session, if you like, to give you that shape of candlestick. And what I've done here, this is a 10-minute chart. I've actually zoomed in on a hammer day now and said what's actually happened. And so every single candlestick on here actually is it's a 10-minute candlestick. But the only 4 bits of data we need to form the daily candlestick is where did it open on that day, which is here, where did it get up to, what's the low of the day, and where did it close. And if we translate those across, we can see we get a candlestick with a small real body and a long lower shadow. And hopefully you can see from that that the long lower shadow is quite clearly the result of a big sell-off, but then a significant recovery and quite a strong close. And so you can think about the balance between bulls and bears and how it panned out over the course of that day. Initially, the sellers gave us this big sell-off from here to here, and that was nothing new. We were in a downtrend anyway. Remember that. This is only a falling market. So seeing that selling again is really nothing, nothing unusual, nothing new, no surprise. What maybe is a surprise is this rally that we see afterwards. It was choppy in this case, but importantly for the buyers, for the bulls, we closed strongly. And so that is what needs to happen to give you a hammer candlestick, to give you a candlestick with a long lower shadow, and and it's a downside rejection. Yeah, said all of that.
Can I just
get through that slide? Yeah, go on, Dan. What you got?
Well, one thing that somebody once said to me was about the hammer chart. Is the way to think of it is the market is beating out a bottom. I don't know if if you'd agree with that, but it's something stuck in my mind and always makes me think, thinking the right way about what's going to happen next.
Yeah, beating out or hammering out a bottom. It really is just what it's saying to you, what that long lower shadow is saying to you is that we've rejected the downside. We have, that was the day we travelled lower as we have been. But then the buyers stepped in, and obviously, being an old hand of the stock market, you understand that there's always people out there who are looking for value, who are looking for, who are waiting for the market to get to a level, a cheap price, if you like, that they consider to be a good place. They consider that to be value, and that's exactly the sort of thing that can cause hammer candlesticks. We can say the market reaches a low enough price for people to step in and go, I like the idea of buying it here, and so actually what happens is you get new buyers and you get bears, you get sellers that suddenly go, well, hang on a minute. I ended up, what you think about if you're bearish of the market and what happens to you over the course of a hammer day. When the market is, let's go back to that previous slide. If you're bearish, where is that previous slide? Come on, let's have it. If you're bearish and the market does this, your P&L just gets better, and you think, yeah, happy days. I'm killing this. The market's bearish and it's going down, and I'm making money because I'm short. But what happens, what are you thinking by the end of this day? You're thinking, well, hang on, my P&L wasn't quite as clever now as it was earlier on in the day. Something may have changed. I might need to have a rethink here. And that's the sort of thing, that's the psychology. I always try and think of that bull-bear balance when I'm looking at candlestick charts to say, has something changed? I think we might be out of time, but I did want to show a live market example. We did post a hammer day on the 1st of October in euro sterling, which was which had been travelling lower. There's one there. So that was a warning that things may be turning around. And then a couple of doji candlesticks there. Then we made a new low, and then the next day we posted a hammer candlestick. I looked back at my reports for this day and I said, And I actually said, we posted a hammer, but we're not going to do anything about it for now because we've got some resistance here and here. Well, after this particular day, we said, oh, good, nice one. That's what we wanted. We wanted to see some confirmation of the hammer. We will buy it today on a dip back to here. And I can show you the report if anyone doesn't believe me. We said to buy it at 78.25, and you know that. And then we saw the market go higher from there. We got out of it somewhere around here. Making 107 ticks on the trade in total. That was a trade that we recommended to our clients. So that's how you can use them in a practical sort of situation. There's not that wasn't the only thing that told us that was an interesting trade. I think yeah, there were other reasons to think that was an interesting trade at the time, which I can't really get into right now. But you know, I would encourage you to start looking out for these. Maybe do some reading. You don't have to buy my book. You can take your pick on the books. And also look, there's plenty online. There's plenty on my website. If you go to futurestext.co.uk, you can have a look. There's lots of things on our blog, and we'd also be happy to give people a free trial on that on our website as well. Actually,